Before we said goodbye to 2023, there was so much news about the stock market dump, making a lot of investors, especially small investors, fear what to do to be safe. But is the stock market ready to dump? Is there a correction already? You may want to invite your fellow investors as we will answer this important question and also talk about what to do to make a profit regardless. But before we go on, let's talk about stock market crash. When the market value drops suddenly because the investors have decided to sell their shares for one reason or another, then we say we have a stock market crash. This action always drives down the value of stocks for all the other shareholders who also start selling their shares to try to cut their losses. There are two causes of a stock market crash, which are a dramatic drop in stock prices and a heavy panic, something that looks like Gotham City at the end of every Batman movie. Of course, we have different stock, but when we want to track the stock market's behavior, we look at indexes such as the Dow Jones, S&P, and the Nasdaq. If you look at a historical graph of one of these indexes, you can see why we use the term crash. It's like watching a plane take a nosedive. So in summary, when investors see that the market is going the hard way, most sell off their stock to get out with as much money as they can before the value drops. That's just a simple explanation of how panic plays a big role in causing a stock market crash as the actual economic issues that led to it. But is that what we are expecting this new year? You must know that this year is a leap year, and somehow markets just act funny around a leap year. We can't say that there's a fundamental reason why the stock market will behave in a particular fashion during a leap year, but it is safe to say that the seasonality effect is too strong to ignore as we are already in 2024. Visiting with one extra day, leap years have a history of coming with consequences, which is all about the leap day. This year is only the 20th time in the history of S&P 500 that February 29th has fallen on a day the market was open, according to S&P Capital IQ. And generally, this bonus day has not been kind to stocks. The S&P 500 only rose 35% of the time looking at the previous sleep days that fell on such trading days, and on average posted a 0.1% decline. Back in 2016, the S&P 500 fell slightly on the leap day even after starting the day up, trading down less than a percentage point. But even with that, investors shouldn't read too much into stocks' performance on leap day itself. What's the good news? According to S&P Capital IQ's US equity strategist Sam Stovall, while the S&P's average returns on February 29th were negative, they were still so close to flat that they didn't offer much of a performance clue as to the stock market's direction for the rest of the year, oddly pushing it one way or the other. In fact, for the previous leap years where the market was open that final day of February, the S&P ended the year up more than 70% of the time, averaging a gain of 6.4%. Indeed, since 1960, the only leap years in which the S&P 500 fell were 2000, 2008, and 2020, which are the years of the worst market crashes since the Great Depression. But other than those special circumstances, leap years tend to be good for stocks, even if that performance has nothing to do with Fed 29 itself. Leap years, of course, also happen to be election years when stocks have tended to turn in positive returns. Either way, even if stocks disappoint this Feb 29th, there's a strong likelihood that they'll have better luck by the end of the year. This happened in the last leap year where the S&P 500 had lost 34% of its value due to COVID-19 pandemic, but in the end, the benchmark S&P 500 finished the year with a gain of 16.3% or a total return of about 18%, including the dividends. With the expected rate cuts in 2024, many experts have predicted a strong year for the economy and the stock markets, but some are more enthusiastic than others. Christina Hooper, Chief Global Market Strategist at Invesco, said we shouldn't expect a recession and at the same time don't expect things to go completely smoothly. Christina is calling for a bumpy landing. She adds that recognizing that in a soft landing, there's no real damage. I think there will be some damage to the economy. It's hard not to have some damage. That was said because of how much and how fast interest rates have risen. Jay Hadfield, CEO of investment firm Infrastructure Capital Advisors, shared his sentiment on Christiana's stake when he said, "Recent economy data validates our theory that 2024 will be the year of rate cuts, and that's very bullish for stocks. A decline in rates worldwide should spell a good year for markets and less of a possibility of a recession. So we're as bulled up as we're ever going to be, probably." Enough of what other things, let's ask the charts. The volatility index. If you're new to this term, it's simply put a way to measure the expected volatility of the stock market. Yes, the volatility index, or the VIX, allows you to do that. It is one of the most recognized indicators of expected market volatility and is widely followed as a daily market indicator. Volatility reflects the amount of risk related to fluctuations in a security's value. It is measured using the variance between returns from a security or index. A highly volatile security can see its price change dramatically in either directions over a short period. On the other hand, a security with low volatility will tend to hold its price over time. We have three types of volatility, which are standard deviation, beta, and implied volatility, but we're not going there today. To dive in, the volatility index, or VIX, is the annualized implied volatility of a hypothetical S&P 500 stock option with 30 days to expiration. The price of this option is based on the prices of near-term S&P 500 options traded on the Chicago World Options Exchange. It can help investors estimate how much the S&P 500 index will fluctuate in the next 30 days. While the VIX only measures the volatility in the S&P 500 index, it has become a benchmark for the US stock market. The VIX is often referred to as the market's fear index, or fear gauge. And to use the VIX appropriately, just inverse them. This means when the price of the VIX goes up, the price of the S&P 500 usually goes down. The VIX can help investors gauge market sentiment as well as volatility to identify investment opportunities. As volatility can also signal negative stock market performance, volatility investments can be used to speculate and hedge risk. This knowledge can be used to make informed investment decisions. Typically, when the price of the VIX is 0 to 15, this can indicate a certain amount of optimism in the market as well as very low volatility. 15 to 25 indicates that there is a certain amount of volatility, but nothing extreme. 25 to 30, this can indicate that there is a certain amount of market turbulence and volatility is increasing. 30 and over, this can indicate that the market is highly volatile and there may be some extreme swings soon. Looking at the current VIX number, we can see it's at its lowest level since January 2020, in the wake of the latest market rally. Most strategists believe the shifting macroeconomic landscape will see the VIX resurge in 2024. Strategists at JP Morgan Chase expect the VIX index to return upward in 2024 after dropping to the lowest level since before the 2020 pandemic. However, the extent of that rise depends on many factors. These include the timing and degree of a potential recession and further fluctuations that could hamper short-term volatility sales. Back on the 11th of January, the VIX was around 12.4 points. At the moment, it's at around 14-15, so we've seen a little increase this last few days. Its previous descent came amid a significant 6-week rally in US equities, fueled by improved market sentiment as investors increasingly expect a soft landing for the US economy and the Fed to begin cutting rates sometime in 2024. In the case of a successful soft landing, JP Morgan strategists predicted VIX to be in the mid to high teens throughout this year on average. That would represent a stark difference from 2023 average, which were close to 17. On the other hand, a potential economic recession in the second half of 2024 could propel VIX to an average reading of the low 20s. At least, there may be a reversion in the market. Now, let's have a look to the relative strength index. This is a momentum indicator used to identify overbought or oversold conditions in the stock. Generally, the period considered for this is 2 weeks. Within 2 weeks, if an RSI is reading below 25, it is interpreted as oversold, while an RSI between 25 and 45 is interpreted as a bearish condition. RSI between 45 and 55 is interpreted as a neutral condition, and RSI between 55 and 75 is interpreted as a bullish condition. Lastly, an RSI reading greater than 75 is interpreted as an overbought. Now the RSI of S&P 500 is reading above 60, and the last time it was overbought, it was in July 2024. We can say the S&P 500 is looking at a double top right now. Very quickly, we are moving to Bollinger Bands. These are a type of price envelope developed by John Bollinger. The price envelopes are what define upper and lower price range levels, while the Bollinger Bands are envelopes plotted at a standard deviation level above and below a simple moving average of the price. Because the distance of the bands is based on standard deviation, they adjust to volatility swings in the underlying price. Bollinger Band use two parameters, which are period and standard deviations. The default values are 20 for period and 2 for standard deviations, although you may customize the combinations. Bollinger Bands help determine whether prices are high or low on a relative basis. They are used in pairs, both upper and lower bands, and in conjunction with the moving average. Before now, the S&P has been riding the upper end around November 2023, and the last time it was like that was in July 2023, which caused 10% sell-off in the stock market. The S&P 500 is also on its way lower and has recently fallen below its 10-day exponential and 20-day simple moving averages, with lower Bollinger Band around 4580 being one potential target. Of course, it is not uncommon that when an index hits the upper Bollinger Band, it retraces to the lower Bollinger Band over time, and in that case, that would be around 4100 on the weekly chart. It isn't uncommon on the monthly chart, meaning a revisit to the lows of around 3600s, because this is what happened in mid-2022, early 2020, late 2018, and in parts of 2016. The December 2023 rally pushed the index above the upper Bollinger Band. We are now in 2024, of course. Have you noticed the recent trend? The market has been very aggressive with rate cuts, and rate cuts to the degree the market has priced doesn't look right. Also, the earnings multiple of the S&P 500 is too high at 19.4. The median price earning for a 12-month forward S&P 500 is 16.4. At roughly $242 in earnings per share, the value of the S&P 500 would be around 3,960 points. That is, assuming that earnings grow by 10%, should they grow by just 5% and are instead $231 per share, the value drops to 3,790 points. So from a fundamental and technical basis, a drop back towards the lower monthly Bollinger Band should not be completely ruled out or viewed as fiction. Fundamentals and technical aspects suggest it be possible, especially if rates increase again and earnings don't live up to the hype. Lastly, the Fear and Greed Index is a measure of the current market sentiment. It is based on the premise that higher fear exerts pressure on stock prices, while higher greed has the opposite effect. The index is calculated based on 7 equal weighted indicators. The index ranges from 0 to 100, where 0 represents maximum fear and 100 signals maximum greediness. What the present market is showing is greed close to the extreme greed territory. When broken down into components, the market momentum shows extreme greed. Market volatility is neutral, demand for safe haven assets is at the level of greed, and junk bond demand is at the level of extreme greed, bringing the average roughly around 70. How has the stock market done so far in 2024? Although we have only spent a few weeks in this year, the market isn't on holidays. However, we are not inclined to draw broader conclusions about 2024 from the first week step it starts. Moreover, while calendar years provide relevant mileposts to measure market performance, this is nothing like a football game. The score, which is the economic and investment conditions, doesn't reset just because the calendar turns. But do we have news about the future with what we have seen so far? Let's start with the end of, which was the case as the S&P 500 rose 4.4% in December. Over the last 30 years, when the stock market stacked a strong rally into the year end, a greater than 4% gain in December, which occurred 5 previous times, the market maintained its momentum with a subsequent January gain in 3 of those 5 instances. So it's not uncommon for stocks to catch their breath after a solid end-of-year run. 17 of the last 30 Januaries saw a gain for the stock market in January. In 15 of those 17, the stock market went on to post a gain for the year. When the gain in January was very high, or let's say greater than 4%, the average return for the full year was 22%. On the other hand, notably weak starts can be sign of a challenging year ahead. The stock market has logged a full year decline 6 times in the last 30 years, 3 of which began with a January decline of more than 4%. Given the market's lofty expectations and significant gains coming into the year, it wouldn't be surprising or alarming to see a more tepid start to the year. That said, history shows that even lousy starts to the year don't assure a poor finish. 2024 may bring a mix of headwinds and tailwinds, but ultimately, we think both bonds and stocks can build on 2023 gains this year. Let's talk about how to invest in 2024. For most investors, whilst expecting there may be a correction, they tend to sell all. In Warren Buffett's words, buy when others are fearful, sell when others are greedy. Instead of selling it all, why not invest in a way you can profit? Unsophisticated investors lose money every time they jump into trends, right at the last moment before the tide turns. But if they are not fast enough, their small losses turn into large losses. They have zero risk management and also ignore position. Therefore, large losses massacre their portfolio. Financial advisors generally caution against making any wholesale changes to your portfolio based on anticipated short-term moves in the market. It could be a time, however, to rebalance your portfolio by trimming some cash from the winningest positions and adding to some laggards. Some experts expect a particularly big year for stocks in the real estate and financial sectors, both of which had growth years in 2022 and haven't bounced back quite as high as the broad market so far in 2023. Likewise, some say rebalancing could shift some of your assets out of large, fast-growing US companies and into areas seen as likely beneficiaries of a broad-based economic acceleration, such as smaller company stocks and names from emerging markets. But for younger investors especially, trying to figure out what will happen in the market is far less important than internalizing the lessons of market history and sticking to their long-term plan. It is difficult to say what will happen to the markets. We can only predict, but you can use these tips. Now, let's get to it. 1, make sure you keep your position sizes appropriate compared to your portfolio. Don't look at your position in dollar amounts, but rather in percentage amounts compared to your portfolio. Next, always maintain your core positions because you're more likely wrong than you're right. Also, hedge your positions, or at least your vulnerable positions, just in case you're right. You can either choose a little bit of an expensive hedge so you are invulnerable to any drop in your portfolio values, or you can choose a cheaper hedge that will allow your portfolio some volatility. But in the case of an extreme sell-off, you will make a profit. While we remain uncertain about the stock market behavior, it is important to stay informed about the market using the experts' predictions, the RSI, the VIX, the Bollinger Bands, and the Fear and Greed Index. Also, instead of panicking and selling all that you have, keep your position sizes appropriate, as mentioned earlier. Maintain your core positions and hedge your positions. You can also take mini asymmetric bets, for if you're right, you'd make meaningful profits. What is your take on this? Let us know in the comment section and subscribe to be aware of next video.